and decision-making technique. Specifically, I want us to talk about the various applications of marginal costing. The various applications of marginal costing. Now, marginal costing is a method of costing, or is a costing method that requires the user to determine variable costs, such that your variable costs will comprise of direct materials, direct labor, direct expenses, and variable overheads. Overheads. Right. This method, known as marginal costing, is also known as contribution costing, or variable costing, or direct costing, It is referred to the above names because you consider you consider direct cost as part of your production costs. You also consider variable cost when you're determining your production costs. So therefore, using marginal costing, your variable production costs will be made up of direct materials, direct labor, direct expenses. Then you're also going to add your variable production overheads. Apart from that, apart from knowing how you determine your production cost using marginal costing, it is also important that we remind ourselves how we determine contribution. So contribution is the difference between your selling price and your variable costs. So it is a difference between selling price and variable cost. This particular concept was covered when we were talking about cost volume profit analysis, both in intermediate level, and we have also covered it in advanced level. However, today I want us to talk about the various applications of marginal costing. So today I want us to talk about the various applications of marginal costing. So the applications of marginal costing is what I want us to do to talk about. The applications of marginal Remember, we've said marginal costing is also known as direct costing. It is also known as what? Contribution costing. It is also known as variable costing. It is also known as variable costing. Why? Because you normally calculate your production cost by considering only variable production costs. Only variable production costs. All right. The first application of marginal costing, application number 1 that we will talk about, is what we refer to as limiting factor. It is known as limiting factor analysis. We have a second application known as throughput analysis. Throughput analysis is the second application. You have make or buy decisions. Number 4, you have special offer decisions. Special offer decisions. Number 5, you have drop or continue decisions. Drop or continue decisions. Drop or continue decisions. Let me start by highlighting the first application of marginal costing. Let me highlight or talk about the first application of marginal. And the first application is limiting factor. Limiting factor analysis. Limiting factor is what is referred to as a scarce resource. So a limiting factor is a resource that is not enough, such that it will normally prevent the company from meeting its demand. So limiting factor is a scarce what? Resource. This is a scarce resource. Is a scarce resource. A resource that is not enough, i.e. a resource that is not what? Enough, or is limited in its availability. In its availability. In its availability. It is limited in its what? Availability. I.e. it is not what? Enough. That resource that is not enough, it may be materials, it may be labor, it may be production capacity, it may be even what? Space. Okay? As an organization, when you are faced with a limiting factor or where you don't have enough resources, you are going to maximize the contribution per limiting what? Factor. So when you don't have enough resources, you as an organization should decide on the units and the product of the product you're going to do what? Produce, such that these products that you're going to produce are the ones that are going to generate the maximum contribution. Now, for us to be able to deal with a question on limiting factor, or for us to be able to identify the product that will maximize the contribution per limiting factor, we must always start by identifying the what? The limiting factor. So the steps that we follow when you want to identify your limiting factor units to produce, steps to follow. Number 1, start by identifying your limiting what? Factor. You determine limiting what? Factor. Once you've determined the limiting factor, the second step is determine your contribution. You must determine your contribution per unit, per product. You determine your contribution per unit, per who? Per product. Number 4 is you're going to determine your contribution. Determine your contribution per limiting factor. Per who? Per unit. Per who? Per product. Per unit, per who? Per product. Next step after that is to determine your to rank, or to determine the rank of your products. And the rank here, or the products that you're going to rank, will be ranked that the product with the highest contribution per limiting factor will be ranked first. Will be ranked what? First. And remember that the contribution per limiting factor per what? Per unit will have been computed by note number 4. Will have been computed by step number 3, not number 4, by step number 3. So we are saying you rank according to the highest contribution, per limiting factor per unit. That should be your order of what? Rank. Then step number 5, you determine your optimal output. And this optimal output will be according to the rank above. According to the rank what? Above in step what? In step D. This step here above. Right. That are the basic steps, or those are the steps that are going to be used when an organization is faced with a limiting what? Factor, a scarce resource. And we can have an illustration. And our first illustration, the illustration I want us to talk about, is a question of April 2022. April 2020. Question 2A. April 2022. Question 2A. The question states, Zinc Limited is a local manufacturer of 3 products, namely X, Y, and Z. The management of the company is unhappy with the current production mix and is seeking advice on the most optimal arrangement. The current production is 10,000 units of X, 5,000 units of Y, and 6,000 units of Z. The management accountant has provided the following information relating to the 3 products. You have your details. You have the product X and Y. The selling price per unit of X is 1,200, of Y is 2,000, of Z is 2,250. Your production cost of materials is 300, of Y is 900, of Z is 600. Your variable overheads of X is 150, of Y is 400, of Z is 450. Additional information. Each type of product passes through 3 departments in which a different type of labor is used. The labor requirements in each department are given below. Department 1, your rate per hour is 20 shillings per hour, where X requires 3 hours per unit, Y 4 hours per unit, Z 6 hours per unit. Department 2, the rate per hour is 40 shillings per hour. Your labor requirements are 1 hour per unit in X, 2.5 hours per unit in Y, 4 hours per unit in Z. Department 3, your rate per hour is 30 shillings. Your labor requirements per unit of X is 5, Y is 7, and Z is 9. Number 2, if there is a shortage of labor in Department 2 and it is not possible to increase labor input hours beyond the fully utilized current hours. Fixed overheads are budgeted at 5 million shillings per annum and are expected to remain constant. A recent market survey disclosed that the maximum sales potential for the company is 12,500 units of X, 7,500 units of Y, and 8,000 units of Z. Advise the management of Zinc Limited on the most profitable production mix and the optimal profit using limiting factor. So I want us to tackle this question of April 2022. Question what? 2A. Let me have that here. We will follow the steps as I have indicated. It is limiting factor, remember. Okay. So the first step is you first determine the limiting what? Factor. That is step number 1. So we even write here, step 1. Determine limiting what? Factor. I'm going to guide you through this slowly so that you see what is happening. So determine limiting what? That is the first step. The limiting factor will be determined by comparing the available resources with the required what? Resource. So here we compare our available what? Resource with your required resource. They are saying currently, note number 2, that there is a shortage of labor in department 2. So here you're going to say your available labor hours in department what? 2. Your available hours in department 2, you're going to have to calculate them now that you've not been given how many hours are available. But additional information number 1, each type of product passes through 3 departments in which a different type of labor is used. The labor requirements in each department are given below. The labor requirements per unit of X in department 2 is 1 hour. But for you to produce X, yeah, you currently are producing how many units? 10,000. Currently are producing 10,000 units. Therefore, for you, the normal or the available labor hours will be dedicated to produce X are how many hours? 10,000 hours. Why? Your labor requirements per unit is how much? 2.5, and your current production is how many units? 5,000 units. Therefore, the labor requirements of what? Of Y will be what? 2.5 by who? By 5,000, which in this case will be how much? 12,500 what? Hours. The third product is who? Z. And to produce Z, you will use 4 hours per unit. You multiply that by your current production, which is 6,000 what? Units. So for you to produce Z, you require 24,000 what? Labor hours in department what? 2. Then after that, you now determine all your total labor hours that the current department 2 has. All the labor hours that are available in department 2 for Zinc Limited. And how many hours do you have available? 46,500 who? Once you've determined your available labor hours, what do you then need to do to determine your who? You will need to determine your required labor hours. Your required labor hours in department who? In department who? Again, you will need to produce X, you will need to produce Y, and you will also need to produce who? Z. For you to produce a single unit of X, you need 1 hour per unit, but the market demand, according to a survey that was conducted, is that you have a potential to sell 12,500 what? Units. Therefore, you will require 12,500 who? Hours to be able to fulfill that particular what? Demand. Why? You have 2.5 hours per unit, but the market demands that you produce 7,500 who? Units. Therefore, you require how many hours? You require 18,750 hours. Then Z, you require 4 hours per unit, or you'll be using 4 hours to produce a single unit, but your demand in the market is of 8,000 units. Therefore, your total required labor hours are 32,000. So you add this 12,500 plus 18,750 plus 32,000. So here you will need or you require 63,250 hours. 63,250 hours in which department? In department 2. Then let's see how much deficit we have. Let's see the deficit. You available labor hours are 46,500 labor hours, but what you currently require is 63,250. Therefore, you have a deficit or a shortage or a shortfall of 46,500, 63,250. Therefore, you have a shortage of 16,750 skilled labor hours in department what? 2. Labor hours in department. Now, because you don't have enough hours here to produce all these units of what? X, Y, and Z, you must decide of the 3 products, which one am I going to produce first? Which one am I going to produce last? Apart from deciding the order of the products you're going to produce, you also will need to determine the units of each product that you are going to produce in that particular what? Period. For us to do that, now that we've determined our limiting factor, we will determine our contribution per unit per who? Per product. But before we determine that, let us therefore here say, therefore, your labor hours in skilled, in department 2 rather, in department 2, it is the limiting what? Factor. The limiting who? That is a limiting factor. How do we know? Because here we have a what? A shortfall or a deficit. You require for 63, but you only have what? 46. You can only use what you have, okay? So therefore, your limiting factor per unit, X is who? 1 hour per unit. Y is who? Is 2.5 hours per unit. And Z, lastly, is 4 hours per who? Per unit. 4 hours per unit. That is the limiting factor per who? Units. And that is also how you determine your limiting factor. Remember, we said a limiting factor is a scarce resource. Those hours of 16,750 represent the scarce hours you don't have. Step number 2 here is to determine your contribution per unit per who? Per product. So let's determine our contribution per unit per product. Contribution per unit. To determine contribution per who? Per unit. Let's determine contribution per unit. How do you determine contribution per unit? The contribution per unit is normally calculated by taking the difference of your selling price per unit and your total variable cost. So we can start with the first product. The first product is known as what? Again, you're going to take your selling price per unit. Your selling price per unit of X is 1,200. You less your variable cost, and the first variable cost is the cost of direct materials. And your material cost is how much? 300. You have another variable overhead cost, is your other variable cost, which is 150. Then you also have a cost known as direct labor cost. And your labor cost was in department 1, department 2, and department 3. Department 1, you are using 3 hours. Department 1, you are using 3 hours at a rate of how much? 20. So that your labor cost is how much? 60. Department 2, let me say, Department 1 is being paid at how much? 20 shillings per hour. So if you work for 3 hours, you're going to be paid 60 shillings. Department 2, you're being paid at 40 shillings per hour. And Department 2, they worked for how many hours? 1 hour. So therefore, they were entitled a cost of how much? 40. Department 3, they're working for 30 shillings per hour. And they worked for how many hours? 5. So 30 by 5 must be 150. Then we determine our contribution per unit. We've said the contribution per unit is simply the difference between your selling price and all your variable costs. Let's go to Y. Your selling price per unit ni ngapi? 2000. Your material cost is 900. Your variable overhead is what? 400. Your labor cost in Department 1, which was paid at 20 shillings per hour, but they worked for 4 hours. So 20 by 4 is 80. Department 2, they worked for 2.5 hours. They worked for 2.5 hours, but each hour is being paid at how much? 40. So therefore, they will be paid how much? 100 shillings. Department 3, they worked for 7 hours and each hour is being paid at 30. So that they will be paid how much? 10. The other department is Department Z. Your selling price 2250. Material cost 600. Variable overhead cost 450. Labor cost of 6 by 20, 120. Department 2, 40 hours per hour by 4 hours is 160. 30 hours, 30 shillings per hour by 9 must be 270. Then we now get our contribution. The difference between what? Selling price and all your variable costs and all the variable costs. Okay, so let's calculate it now. Let's calculate it. Remember, we are determining our contribution per unit. 1200 minus 300 minus 150 minus 60 minus 40 minus 100 and what? 50. The contribution per unit of X will be 500. 2000 minus 900 minus 400 minus 80 minus 100 minus 200 and 10. 310. 2250 minus 600 minus 450 minus 120 minus 160 minus 270. That must be 600 and what? Step number 2 is done. So let's go to step number 3. Step number 3. I hope we are together. We have successfully determined the contribution per unit. The next step on dealing with limiting factor is to determine your contribution per per limiting factor per unit. So let's go to step number 3. Factor per unit. Determine contribution per limiting factor per unit. You have X, you have Y, and lastly you have which product? Z. To determine the contribution per limiting factor per unit, you're simply going to take your contribution you divide that by your limiting factor, and your limiting factor, remember we said, is your labor hours. So you're going to divide this by your labor hours. You're going to divide that by your labor what? Hours. Your labor hours per unit. X, Y, Z. The contribution per unit is as per step 2, 500, 310 and 650. 500, 310, and lastly how much? 650. You divide that by your labor hours per unit. That is the limiting factor. Remember, these labor hours per unit are the limiting factor. X is 1 hour, Y is 2.5, Z is 4. So you say 1 hour per unit, 2.5 hours per unit, and 4 hours per unit. So this will give you your contribution per labor hour per unit. Per labor hour per unit. 500 divided by 1 is 500. Then 310 divided by 2.5 must be 124. 650 divided by 4 must be 162.5. 162.5. We have determined the contribution per limiting factor by simply doing what? By taking the contribution, you divide by your limiting what? Factor. And remember, your limiting factor was the labor what? Hours. It was the labor hours. The fourth step is to rank, or what we simply denote as priority ranks. When we say priority rank of production, it is basically you want to identify of the 3 products you want to produce. Which one will you produce first? Which one will you produce second? Which one will you produce the third one or the last one? You want to produce X, Y, and who? Z. Now, the rank in here is normally based on what? It is based by the maximum, or you compute it, or you consider your maximum contribution per limiting factor. So once you've determined your contribution per limiting factor, you're going to look at the one with the maximum what? Contribution per limiting factor. That you're going to rank it as number 1. Then the second, you're going to rank it as number 2, and so on and so forth. Our contribution per limiting factor, which is your contribution per labor hour per unit, was how much? 500 for X, 124 for Y, and 162.5 for who? Z. Then you do what? Rank. According to the contribution per limiting factor above, the first rank should be product 1. Product 1, which is what? X. Let me write that using a different color pen. Product 1. Then product 2 is Z. Then product 3 is Y. Because the one with the highest contribution per limiting factor is X. Then the next highest is Z. Then the least highest is what? Y. That is step number 4. Step number 5 is now to determine the units of output of each product that you're going to do what? That you're going to produce, what we refer to as optimal production mix. Optimal production what? Mix. So here we want to identify according to the ranks here, and now that we only have 46,500 hours, how many products of each product are we going to produce? How many units of each product are we going to produce? So you're going to start here by identifying the products according to the rank here. Then have your available limiting factor, and we know what is our available limiting factor. Your available limiting factor is your labor hours. Your labor hours was the limiting factor. Then your required labor hours, which is now your required limiting factor. Then lastly, you have your output, and your output is in what? Units. Your output is in units. Wonderful. The first product we want to produce according to our rank is what? X. So here we write product X. The available hours that organization currently have is 46,500 hours. So here you write 46,500 hours. For you to produce product X, the required labor hours here are how many hours? 12,500. 12,500. And then now we need to identify our output. Okay, but remember that X, for you to produce a single unit, you are using how many hours? 1 hour. So if you have 12,500 labor hours, how many units are you going to do what? To produce. So what will you do? You're simply going to take your required hours, 12,500, you divide by the labor hours per unit, which in this case was how much? 1 hour. So at the end of it all, you will need to produce 12,500 units. 12,500 units. The next product according to our rank is product Z. We write here product Z. Now your available hours will have to do what? To change. Why? Before production of X, you had 46,500 labor hours, but you have used how many labor hours? 12,500. So for you to produce Z and Y, you only have how many labor hours now available? 34,000 labor hours. which is simply 46,500 minus 12,500 to give you 34,000. Then we ask ourselves, for us to produce Z, how many labor hours do we require? And we require how many labor hours of Z? 32,000. 32,000. So here we are going to write how many hours? 32,000. Then let's identify the units we want to do what? Produce of who? Z. For you to produce a single unit of Z, you required how many hours? 4 hours per unit here. If you currently have 32,000 labor hours, how many units are you going to use to produce? So you'll take 32,000, you divide by who? By 4. So you're going to produce how many units? 8,000 units. 8,000 units. The last product that we will produce, that we should produce, is product who? Y, because it is the one that was ranked number 3. For you, before you produced Z, you had 34,000 labor hours, but you have used 32,000. So therefore, how many hours are remaining? 2,000. But for you to produce Y, you require how many labor hours? 18,750. Now that you don't have 18,750, how many hours are you going to use? 2,000. Remember, you can only use what you have. Okay, so here, even if you require 18,750 hours to produce Y, what do you currently have available? 2,000. And these 2,000 labor hours are the ones you're going to use to produce a certain number of units of who? Y. And how many units are you going to produce? You're going to take your hours that are required, 2,000 hours, then you divide that by how many hours each unit is producing. For Z, for Y, which is how much? 2.5. So you divide this by 2.5. So you should end up producing how many units? 800 units. You will end up producing 800 units of Y. Now that is clear, we have determined the units of each product that will utilize our who? Our contribution margin. This question also required us to determine the optimal production what? Mix. This is your optimal production mix here, but they were also telling us to determine our optimal profit. Now, your profit here, we know, is given how? How do you determine your profit? Your profit is determined by taking P minus V, you multiply by the units, minus your what? Fixed costs. Minus your fixed cost. But remember, P minus V is your contribution what? Margin. You multiply by your units, minus your who? Fixed cost. Minus your fixed cost. Then, so let's determine our contribution. Our contribution, which you know it is your contribution margin. You multiply by your who? Units. But now, these units here, we are going to use the optimal what? Output units. Because they're asking us for the optimal profit. Therefore, the optimal output units here are the ones we're going to multiply by the contribution of each product to determine our total contribution. How is that we're going to do? Let's start with product X. Product X, your contribution margin of X is how much? 500 per unit. you multiply that by the units of X that are optimal. And the units of X that are optimal is how much? 12,500. So you multiply here by who? 12,500. The next product is who? Y. And Y, your contribution margin is how much? 310. Then 310 you multiply by your who? Optimal output, which is 800 here. So what? 310 by 800. The next product is who? Z. Your contribution per unit is 650. You multiply by the optimal output of Z of 8,000. So 650. You multiply by who? 8,000. You multiply by 8,000. So let's determine that. 500 by 12,500. That should be 6,250. Return by 800 to 48,000. $650 by 8,000. You now get the total 62,50,000 plus 248,000 plus 5,200. $11,688,000. This will give you your total contribution. But then we need to subtract our who? Fixed costs. Your fixed cost. And how much was your fixed cost? Your fixed cost was given by note number 3. And your fixed cost by note number 3 is saying fixed overheads are budgeted to remain at how much? A constant value of 5 million. So we are going to subtract 5 who? Million. So hapo here your net profit will be how much? 6,698. So therefore your optimal profit is how much? 6698 what? 6898,000. 6898,000. And that is how we did with limiting what? Factor. With limiting factor. Now, in case they had asked us, let me just highlight this. In case they had asked us for your maximum profit, sometimes they may also ask for your maximum profit. In case they ask for the maximum profit, yeah, you're going to determine your maximum profit here by taking your contribution margin or your contribution CM by your units of Q. But now these units here are Q are the units that correspond to maximum what? Sales or maximum what? Output. So these Q units here, should be what units? Your maximum units sold. Your maximum what? sales demand here. And the optimal production mix, when they ask for optimal profit, I hope you've realized, and I know you've noticed, that these units are the optimal units produced. Optimal units produced here. And these are these units here. But now, when they say what? Determine maximum profit, your contribution will be a product of your contribution margin. But now the units are the maximum available what? Sales. Let me even use this question to show you how, what I mean by that. We can start with X. No changes to the contribution margin, 500. Then your maximum sales demand, was given by additional information number who? Number 4, where X, your maximum sales is 12,500. Y, your contribution margin is what? 310. With the maximum sales demand of who? 7,500. Z is 650. With a maximum sales demand of how much? 8,000. 8,000. So let's calculate this. Let us calculate this. 500 by 12,500. That is 6250. $310 by 7,500. 23 to 25,000. 650 by that is 5.2 million. Your total contribution $62.50 plus 23.25 plus 5.2, 13,775,000. Then you less your fixed costs. And your fixed cost, remember, do not change with output. So therefore, they will be how much? They will remain a constant of 5 million. Your net profit is 87,75,000. Therefore, maximum profit is how much? 87,75,000. 87,75,000. And that is how we deal with limiting what? Factor. With limiting factor as scarce resource. Right. Now that we're done with limiting factor, or we have covered the limiting factor successfully and exhausted that, in the next session, I want us to cover throughput counting or throughput analysis. And throughput analysis is very, very close to limiting what? Factor. It is very, very close. So they are more or less related. Still, you want to determine the number of units that you want to produce when you don't have enough what? Resources. All right. So thank you. See you next time.
Hello candidates, and welcome to the Advanced Auditing and Assurance Learning session. The subtopic is audit of banks. To remind you, the general objective of the advanced auditing and assurance paper is to enable the candidates to gain knowledge and skills to undertake advanced audit and assurance engagements in compliance with regulatory frameworks and international auditing standards. The subtopic audit of banks candidates, by the end of this study on the audit of banks, it is expected that you will gain knowledge and skills to enable you to undertake audit and assurance engagements which are in line or in compliance with the regulatory frameworks and international auditing standards. In the study of audit of banks candidates, we will study audit objectives, the terms of engagement, planning the audit of a bank, the internal controls. On internal controls, we will consider the policy paper that was issued by the Basel Committee on Banking Supervision, dubbed Framework for Internal Control Systems in Banking Organizations. Then we will also study the substantive procedures that are required in the audit of banks, then the audit report on the financial statements of banks. So candidates, welcome to the session, Audit of Banks. I just stated that in auditing of financial statements, the auditor should pay attention to the regulatory frameworks and international auditing standards. That is regulatory frameworks and international standards on auditing. The Banking Act of 2015, Section 24, requires that every institution to appoint annually an auditor who is qualified and approved by the central bank, whose duty is to audit and make a report upon the annual balance sheet and the profit and loss account, which are to be submitted to the central bank. That is Section 24 of the Banking Act. Section 24. Section 24 of the Banking Act of 2015. Now, Section 25 of the same Act talks about change of auditors, and such changes of auditors of a bank should be notified to the central bank. And Section 26 of the Banking Act is about auditors' duty of confidence. Auditors' duty of confidence. Now, the audit of banks is governed by the International Auditing Practice Statement number 1006. This statement is about the audit of financial statements of banks, financial statements of banks. And the purpose of this statement is to provide practical assistance to auditors and to promote good practice in applying international standards on auditing of the financial statements of banks. Learners, it should also be noted that this statement is not intended to be an exhaustive listing of the procedures and practices to be used in such an audit. And therefore, in conducting an audit in accordance with ESAS, the auditors comply with all the requirements of all the international standards on auditing. But we all know that banks commonly undertake wide range of activities. However, most banks continue to have in common some basic activities of deposit taking, borrowing, lending, settlement, trading, and treasury operations, and so on. So this statement, the primary purpose for this statement is the provision of guidance on the audit implications of such activities. I've mentioned the activities like borrowing, lending, settlement, trading, treasury operations, and so on. So before we get into the audit of banks, I think it's important for us to highlight some of the basic characteristics that generally distinguish banks from other commercial enterprises. Basic characteristics of banks. Basic characteristics of banks. Number one is that banks have custody of large amounts of monetary items. Custody of large amounts of monetary items. Large amounts of monetary items, including cash, including negotiable instruments, whose physical security has to be safeguarded during transfer and while being stored. They also have custody and control of negotiable instruments and other assets that are readily transferable in electronic form. So candidates, the liquidity characteristics of these items make banks vulnerable to misappropriation and fraud. Banks therefore need to establish formal operational or operating procedures that are well defined that have well-defined limits for individual discretion and rigorous systems of internal controls. So that is one basic characteristic of banking institutions that distinguish banks from other commercial enterprises. Large amounts of monetary items. Then number 2 is that banks often engage in transactions that are initiated in one jurisdiction and managed yet in another jurisdiction. Transaction is initiated, for example, in one continent, and then the management of that transaction is done in another continent. Number 3, banks operate with a very high leverage. Very high leverage. That means that the ratio of capital to total assets is low. And this increases banks' vulnerability to adverse economic trends and increases the risk of failure. High what? Leverage. They operate with very high leverage, meaning that the ratio of capital to total assets is low. Then another characteristic is that banks have assets that rapidly change. Assets that rapidly change in value and whose value is often difficult to determine. Consequentially, a relatively small decrease in asset values may have a significant effect on their capital and potentially on their regulatory solvency. Another property is that banks generally derive a significant amount of their funding from short-term deposits, and these deposits may be insured or uninsured. Therefore, a loss of confidence by depositors in a bank's solvency may quickly result in liquidity crisis. May do what? May result in liquidity crisis. Liquidity crisis. Another feature is that banks have fiduciary duties, and these fiduciary duties are in respect of the assets they hold that belong to other persons. And these fiduciary duties may give rise to liabilities for breach of trust. So they therefore need to establish operating procedures, internal controls designed to ensure that they deal with such assets only in accordance with the terms on which the assets were transferred to the bank. Next point is that banks engage in a large volume and variety of transactions whose value may be significant. And this ordinarily requires complex accounting and internal control systems and widespread use of information technology. Another characteristic is that banks ordinarily operate through networks of branches and departments that are geographically located or geographically dispersed. This necessarily involves a greater decentralization of authority and dispersal of accounting and control functions. with consequential difficulties in maintaining uniform operating practices and accounting systems, particularly when the branch network transcends national boundaries. Next characteristic is in relation to transactions which often may be directly initiated and completed by the customer without any intervention of the bank's employees. For example, transactions that are carried out over the internet or through the automatic teller machines and so on. So these are some of the basic characteristics of banks that distinguish banks from other commercial enterprises. Now, learners, that will mark the end of our today's learning session where we've introduced the subtopic audit of banks. And in this session, we've learned that an auditor should have knowledge and skills to undertake the audit and assurance engagements that are in line with regulatory frameworks and international standards on auditing. In this lesson, we also learned that the audit of banks is regulated or guided, or we can say auditors seek guidance, get guidance from the International Auditing Practice Statement number 1006. This statement is about the audit of financial statements of banks. In the lesson, we've gone ahead to identify some of the basic characteristics of banks. These characteristics are common to banks, and the characteristics distinguish the banks from other commercial enterprises. In our next session, we will study audit objectives of banks and terms of engagement. Thank you and God bless you.
Ordinary least squares method, sometimes also known as regression. First of ordinary least squares, which is simple linear regression method, which is a cost estimation method that requires you to form simple linear regressions of the form y is equals a plus what? bx, okay? Where a is given by the summation of y minus b summation of x divided by who? N. Then the value of b is n summation of xy minus the summation of x summation of y by n x squared minus the summation of x. You do what? You square. Now the difference between these two, is simply this: you're squaring x individual, but here you first get the total of x, then you do what? You square. You first get the total of x, then you do what? You square. All right. There are certain steps we can follow. Your steps using your calculator. And the calculator I want us to use is FX82 MS. Is your calculator known as FX82 MS. The first step there is always to switch on your what? Calculator. Always to switch on your calculator. That is a first step. Once we have switched on our calculator, the second step is to reset your calc. Reset the calculator. Reset the calculator. And you reset your calculator by pressing, Shift Mode All, which is given by number 3, then equals. That is the second step, resetting your calc. Now you reset your calculator because you may have previously saved data. And that previously saved data will affect the result of your equation. So therefore reset it so that it doesn't affect the result of your current result that you intend. The third step is to do what? Is to set calculator in a regression mode. How do you do that? You press mode, then regression, then regression is denoted by number 3, then linear denoted by number 1. Step 4 is input your data. When you are inputting your data, how do you input it? You input it in the form of x, y, m plus. X, y, m plus. This m plus here simply means memory addition. That m plus there means memory addition, which is the same function like in your computer known as what? Save. So this is known as save. So you add that, or you press m plus so that you can add data in your calculator and store it there. Then I want us to do this December 2024 together. We do this December 2024 together. And I want to show you how we input that data, how we input it. I hope we have reset our calculator. We have set up the calculator in regression mode. I want to show how now you input it. X is 1425. So what do? You're going to press 1425 in your calc. Then next to the DEL and AC buttons, you press 12185 and then M plus. Remember, the comma and the M plus are slightly above the DEL and AC buttons. If you press 1425, 12185, M plus, N should give you 1. N is equal to 1. The next observation is 950, 9875, M plus. So that is the second observation. The third observation is 1190, 10450, M plus. The fourth one is 1690, 15 to 80, M plus. 1006, 9915, M plus. 834, 9150, M plus. 982, 10133, M plus. 1259, 11981, M plus. 1385, 12045, M plus. 1420, comma 13 180 m plus 11 25 comma 11 910 m plus 980 comma 10 431 m plus, such that now the last observation of 980 10 431, after you press m plus, n will be equal to 12, n will be equal to 12. Okay, then the next step is to obtain your data, the data values which are unknown to us, and so far you don't know the value of all this, you also don't know the values of all that, but since you have imputed everything in your calculator, you can be able to obtain them. And how do you do that? You simply press shift 1, press shift 1. When you press shift 1, the first screen, there is a summation x squared, the summation of x and n. To select any value, you press the number below it. For example, when I want this summation of x squared, I'm going to press 1, then equals, so that will give me 17 483 772. Press shift 1 again. When I want the summation of x, I simply press 2, then my equal sign, 14 186, shift 1, then n is given by number 3. I remember to press my equal sign, that will give me 12. Okay, that being the first screen, we can go to the next screen by pressing shift 1 and your arrow key, shift 1 and your arrow or direction key to the right. In the calc, there are 4 buttons just on top of your calculator. Between alpha and mode, there are 4 direction keys there. So you're pressing shift 1 and moving to the right, such that the summation of y squared can be obtained by pressing 1, then equals 370 811, shift 1, the summation of y, move with your direction key, the summation of y is 136 535, the summation of xy all right. Now if you look at your formula for b here, we have everything except this here. This is the only item you don't have, but since we know the summation of x, we simply square it and say the summation of x squared will be 14 186 squared, will simply be 14 186 squared. All right, that is when you use shift 1, or that is how you use shift 1. Now to obtain our values of a and b, we can simply use what? Shift 2, and we move with the direction key twice to the right, shift 2, and move to with the direction key twice to the right, starting with a. You're going to press the number below that, which is 1, then equals 295, shift 2. B, the number below that is 2, so press 2, then equals 6.48 692. But we know our equation should be of the form y is equals a plus what? Bx. The value of a is 3709.295 plus 6.48 692 of who? X. 6.4869 2 of who? Of x. And that is how we form equations using what? simple linear regression method. Using simple linear regression what? Method. Right. The next thing we should be doing, or I should show you, is how you're going to deal with multiple regression. So multiple regression. Allow me to do away with this. We will come back to evaluation. There's a concept there. So we will need to evaluate. I'll show you how to evaluate your what? Regression equation. But before that, let me show you how we deal with what? Multiple regression. Before we come to the evaluation, let's talk about multiple regression. Multiple linear regression method. Just multiple linear regression. Now, with multiple linear regression method here, this is a regression method where you use it when you have more than one independent variable x. When we talked about simple linear regression here, x is only one, y is equals a plus b, x is only one independent variable. But it is possible that you have more than one factor affecting your costs. Okay, so where you have more than one independent variable or a factor affecting your cost, you're going to introduce the concept of multiple linear regression method, but your equation is still a straight line. So it must be of the form y is equals a plus b1 x1 plus b2 x2 all the way to bn xn, where x represents your independent variables. How many independent variables are there? So if you have an independent variable for who? For income, you will have it. If you have an independent variable for age, you are going to do what? To have it. So either way, this is how you form a regression what? Equation. That is the general form of your regression what? Equation of more than one independent variable. Of more than one independent what? Variable. All right. Once that is done, I want to show you how you do what? How you are able to form what? Predictor equations. How you're going to form predictor equations. So I want us to go to last sittings question. So I want us to talk about April 4B. Question 4B. April 2025. Question 4B. They're saying Global Logistics Limited has two operating segments, Longonot and Zoea. Longonot division orders most of its consignment of immediate output from Zoea division using economic order quantity model. The managers of each division are given considerable autonomy in transfer pricing policies. Longonot division managers want to use multiple linear regression analysis to evaluate the significance of the independent variables on material handling of cost of its consignments. And they also say the finance director of Global Logistics has availed the following data for Longonot Limited for the past 10 months. You have your month, your material handling cost is Y, number of orders is X1, number of kilograms is X2. The computer output is as follows. So you have that note number 1. Then analysis of variance table, you also have it there as number 2. And number 3, then required, write down the multiple linear regression function of y is equals to a plus b1 x1 plus b2 x2. So allow me to copy this table. There are 2 tables, or rather there are 3 tables that I will need to copy so that I show you how you get those what. This is called an ANOVA table. It's the one I want to copy, which is what we refer to as analysis of who? Variance. Analysis of variance table. I'm copying this so that I can show you how you obtain your various what? Various equations when you're given an ANOVA table. when you're given an ANOVA table, I want to show you how you get your regression equation. So you have your regression. Regression is also known as model. Residue is also known as error. 2, 7, total is 9, 34, 6, 1, 3, 0, 2, 0, W, 34, 653, 200, 17, 30, 65, 10, 57, 39.99, 15.06, 0767, 22. Then you have your parameter estimate table. You will have your variable, coefficients, standard error, and your T ratio value. Of your intercepts, x variable 1, x variable 2, 5 of 7.3097, 7.83, 5162. 57, 3225, that is Z, 0.0037, 42, 8.85, 009, 8, 33.47672. This is 28. Two 286. Okay, here there are some certain variables that are unknown. This is W. Let me use a different color pen. That is Z. That is it. Okay. Now, the first part of that question, they're saying write down the multiple linear regression. The form y is equals a plus b1 x1 plus b2x, b1 x1, a plus b1 x1 plus b2 x2. Now, the first thing you realize is that x1 and x2 you must be given, okay, and also that you must be given, where we know x simply means the independent, y means the dependent. In this case, x1 is number of orders. Number of who? Orders. X2 is the number of kilograms. You must select those two. Number of kilograms ordered. Y is your material handling cost. Y is your material handling what? Cost. So Y will be, you know, A is normally the what? the independent variable known as the intercept of y, and the intercept of y is here. The intercept of the coefficient, so y is 507.3097 plus the coefficients of x1 and x2 are the ones you're going to refer to as your what? B, B. So B1 here will be 7.835162 of x1 plus 0.10781 of x2. So these coefficients here are the ones that give you A, B, and all the B's. All right, that is that. Part 2 of that question. They were telling us, suppose in the month of April, longer knot division expected to have 350 orders with 17,000 kgs of material ordered. Predict the total material handling cost for the month of April 2025. So this second part here is what we refer to as estimation or forecasting. Forecasting is where you use your relationship here. This relationship is cost estimation. Use this relationship to predict future what? Cost. So they are simply asking you for your future what? Material handling cost. When you have ordered how much, you have made 30 orders and received 17,000 what? Kgs. So you're going to say y when x1 is equal to who? 350 orders, and x2 is equal to who? 17,000 is equal to 17,000. So you simply now substitute, the equation of y is 507.3097 plus 7.835162 times 350 plus 0.10718, but you are ordering 17, you received 17,000. So let's work this one out. 507.3097 plus 7.835162 by 300 plus 0.107181 by who? 17,000. So the total cost of what? Of materials is 4679.9353, and that is how you deal with what? How you deal with multiple linear regression, on how you solve your what? Your equation, all right, or how you form your equation. That is good. Now, once you have formed your equation, the next thing we should do is to evaluate what is this equation good for prediction, or is this equation using the least squares or the simple linear regression, is it significant, or can it be used to predict? Or if used to predict future cost using these two equations, are the costs going to be accurate, or are they not going to be accurate? So, and for you to do that, you now use various methods of what? Analysis of what? The regression equation. There are various methods that we tend to use to analyze your regression equation. The first method is what we refer to as economic plausibility. We refer to it as economic what? Plausibility. So now we are introducing another concept. We are introducing another concept of analysis or analysis and interpretation of regression what equation, analysis and interpretation of regression equation, okay, which is still under this.
Now allow me to move to the next part of the question, which is on CVP. Let's move to the next part of the question. Part C of the question reads, Tinga Limited manufactures and sells a single product named T140. The following information relates to the product. Selling price per unit is 180, variable cost per unit is 80 shillings, fixed cost per annum 5 million, required Roman 1, break-even point in shillings and in units for max. Roman 2, the total number of units, the number of units to be produced to earn a profit of 1.2 million. That is the question. We need to calculate, first of all, the break-even point in units, then the break-even point in shillings. So this is part C. We are to calculate the break-even point in units. To calculate the break-even point in units, we know the formula is fixed cost over contribution margin. Just fixed cost over contribution margin. So what is the fixed cost in this question? 5 million. The fixed cost here is 5 million shillings. What is the contribution margin? We know the contribution is equal to selling price minus variable cost. Contribution margin is equal to selling price minus variable cost. The selling price here is 180. The variable cost from the question is 80. So that will give us the break-even point in units. This will be equal to 5 million divide 180 minus 80 is just 100. It's just 100. This is equal to 50,000 units. Now this is the break-even point in units. That means that if the company is to produce 50,000 units, the company will not make any profit, because at break-even point, profit is equal to 0, which means that the total cost equal the total revenue. At break-even point, total revenue is equal to total cost, and we know profit is equal to total revenue minus total cost. So total profit is equal to revenue minus the cost, which will be equal to 0. If the company produces 50,000 units, there is no profit at this point. This is the break-even point. The first shilling of profit will be made after the 50,000th unit. That will be 50,001 units. So that's the break-even point in units. Then to calculate the break-even point in shillings, that will be equal to the fixed cost over contribution margin ratio. Contribution margin ratio. So we are going to have it at 5 million minus the contribution margin ratio. How do you calculate the contribution margin ratio? Contribution margin ratio is equal to the selling price minus variable cost. That gives us the contribution. Then we divide by the selling price. So this will be equal to 180 minus 80 over 180. So that will be the contribution margin ratio. So 180 minus 80 is equal to 100. 100 divided by 180. This is equal to, the contribution is 0
0.555555. So we divide the 5 million. This gives me 0.55555. So I'm going to divide the 5 million by that ratio. 5 million divide 0.55555. So roughly I'm getting 9 million. When I round off in shillings, this will be 9. That is the contribution margin. I mean the break-even point in shillings. The break-even point in shillings is equal to 9 million shillings. So that is how candidates should calculate the break-even point in shillings and in units. Then the second part of the question reads, look at the question. The number, this is Roman 1, C1, C2, we are to calculate the number of units to be produced to earn a profit of 1.2 million. Number of units to earn a profit of shillings 1.2 million. Now this will be determined, the formula to the number of units. We have to calculate the number of units to earn a profit of 1.2 million. This will be equal to the fixed cost. You remember the formula we gave in our class. This will be equal to the fixed cost plus the target profit. We get the fixed cost plus the target profit. Then we divide by the contribution. We divide by the contribution margin. We divide by the contribution margin. So we know the fixed cost is 5 million. We know the target profit is 1.2 million. This 1.2 million, 1.2 million. We know the contribution margin. Of course, it's supposed to be units. The contribution margin, we had calculated it. Contribution margin is 100. This is the contribution margin, 180 minus 80, which is equal to 1. So this will be equal to 5 million plus 1.2 million, that's 6.2 million. That will be equal to 6.2 million. 6.2 million divided by 100. This is 62,000 units. 62,000. So if the company intends to earn a profit of 1.2 million, then the company must produce 62,000 units. And you can see 62,000 units is greater than the 5,000 units at break-even point. So profit is made after 1,000 units. At 50,000 units, there is no profit. If the company is to make a profit of 1.2 million, then the company has to produce 62,000 units. That is the meaning. So it's possible to calculate the number of units at a given target profit. So that's it, candidates, for today's lesson. We've answered the question that was tested in August 2024, question 3. On our website, we have provided more questions. Our intention is to answer all questions that have been tested before. If you go to our website, you'll find all these questions have answered, and we subsequently revise our content to ensure that we capture all present sittings. If you have any questions, please feel free. You can get us directly. We have our numbers online. If you have questions, if you need special attention, please call us, and we are ready to help you pass your exams and to gather knowledge that will be useful as you build your career. Bye-bye.
Greetings, candidates. Welcome to the study of the subject leadership and management. And in my hand, I have the KASNEB syllabus that was released in 2021. 2021 KASNEB revised syllabus for paper number 13, Leadership and Management. This paper was renamed from Strategy, Governance and Ethics. And in our today's lesson, I'm going to do an adumbration of this subject. The unit description is as follows. The syllabus reads that this paper is
intended to equip the candidate with knowledge, skills, and attitudes that will enable him or her to apply and demonstrate leadership and management skills to grow an enterprise under various circumstances and environments, including under uncertainties. That is the main objective of studying leadership and management. It is to equip the candidate with knowledge, skills, and attitudes that will go a long way to enable the candidate apply and demonstrate leadership and management skills in order to grow an enterprise under various circumstances, various environments, including uncertain environments. The syllabus also lists 5 learning outcomes. A candidate who passes this paper should be able to, number 1, demonstrate an understanding of leadership techniques and management principles. Leadership techniques and management principles. Number 2, apply knowledge of leadership and management theories in organizations. Number 3, effectively undertake management functions. Number 4, make rational management decisions in an organizational context. Then lastly, embrace and manage strategic change. These are 5 learning outcomes. Now, candidates, the content is organized in 12 topics. 12 topics. The first one is Introduction to Management. Number 2, Evolution and Development of Management Thought. Number 3, Leading as a Function of Management. Number 4, Other Functions of Management. Number 5, Environmental Analysis. Number 6, Leadership Approaches and Strategy. Number 7, Decision Making. 8, Enterprise Management. 9, Project Management. 10, Marketing Management. 11, Leadership and Strategic Change. Then lastly, Case Studies in Leadership and Management. Case Studies in Leadership and Management. These are 12 topics. 12 topics. And candidates will be covering each topic at a time. Each topic at a time. For example, the first topic, Introduction to Management, we will study the nature of management, importance of management, levels of management, multidisciplinary nature of management, roles of management as advocated by Henry Mitzbach, the changing roles of managers and management, qualities of an effective manager, management and administration. These are the subtopics under the first topics. Then in topic 2, there are 3 categories of evolution and development of management thought. Is organized in 3 subsections. Number 1 is the classical approaches to management. Number 2, behavioral management approach. Then modern management theories. The third topic, leading as a function of management, will study differences between management and leadership. We'll study attributes and skills of a good leader. We look at the delegation, responsibility, and accountability. Then we will cover power, authority, and accountability. In topic number 4, which is known as other functions of management, we will discuss the planning function, the organizing function, the staffing function, and the controlling function. Topic number 5, which is environmental analysis, we are expected to cover microenvironment, macroenvironment, internal environment,
external environment and tools of environmental analysis. Then in topic number 6, leadership approaches and strategy, we look at the leadership traits, leadership styles, leadership skills, formulation of an organization's strategic direction, differences between transactional leadership and transformational leadership, conflict resolution mechanisms, then ethics in leadership. In topic number 7, we'll discuss the importance of decision-making models, types of decisions, decision-making process, problem-solving skills, decision-making under different conditions, challenges in decision-making, effective, and lastly, effective decision-making. In topic number 8, we are expected to study the meaning and concept of entrepreneurship, entrepreneur development, enhancing creativity and innovation in organizations, methods of generating ideas, introduction to business plan, protection of intellectual properties. That is the last subtopic in the study of enterprise management, protection of intellectual properties. In topic number 9, candidates are expected to cover number 1, project management concepts. Number 2, characteristics of a project. Number 3, importance of projects. Number 4, features of projects and baseline surveys. Number 5, illustration of the project life cycle. Number 6, project planning and organizing. Number 7, project resources and costing. Then lastly, number 8, project completion and evaluation. In topic number 10, known as marketing management, we will discuss the meaning and importance of marketing. We will look at the marketing management orientation and or philosophies. We study the marketing mix. We'll discuss the development of marketing information. Number 5 is the marketing strategies. Then we have marketing research and intelligence. And lastly, international marketing and e-commerce. Topic number 11, leadership and strategic change. We will consider the meaning of change, theories of change, types of organizational change, managing resistance to change, organizing the change context, levers for strategic change, methods of introducing strategic change, problems of formal change programs, leading change is the last subtopic under leadership and strategic change. Then lastly, there is a case studies in leadership and management. Case studies, we will discuss or look at different case studies in leadership and management. So candidates, these are the areas that you are expected to study in your endeavor to gain knowledge, skills, and attitudes that will enable you to apply and demonstrate leadership and management skills to grow an enterprise. And that should be done under various circumstances. You are expected to manage an enterprise under various circumstances and environments, including uncertain environments. So I hope, candidates, you will be joining us in all the lessons. We are going to cover each and every aspect of this syllabus. It is expected that as we go through this syllabus, when you join these classes, make sure you take down notes. If you have questions, you are free to post your questions. Below this syllabus, there is a comment section where you can ask questions. Make sure you also practice active recall. Carry out continuous revision. Over and above the video lectures, we have also developed the study materials, study texts, and revision books based on the revised syllabus that was promulgated in the year 2021. The books are updated and they cover all these areas that we've mentioned. So make sure you study ahead. Study ahead. Always study ahead. Make sure you familiarize yourself with the various aspects of the syllabus, and as we progress with this coverage of this syllabus, make sure you always go back, answer questions, past paper questions, because some of the topics in leadership and management were retained, because I remember I said that this subject, leadership and management, was just renamed. In the old syllabus, the paper was known as strategy, governance, and ethics. There are certain topics that were maintained, like the first one, introduction to management. There is a topic on evolution and development of management thought. Other functions of management were also retained, like the planning function. We covered it in the previous syllabus, organizing function, the staffing function, controlling function, and even leadership approaches and strategy. These are some of the topics that were retained in this current syllabus. All right. The only new topics that were introduced here I can see is enterprise management. Some subtopics are enterprise management. Project management is also a new topic, including marketing management. Though candidates in the old syllabus, when some of us were studying this course, we studied project management and marketing management. These topics have been reintroduced in the syllabus. So you can see, candidates, we have past paper questions from these areas that I've mentioned. So as we progress, make sure you revise, look at the past paper questions from our revision partners. Check our revision partner. We have past paper questions with solutions. So as we progress with the coverage of this syllabus, make sure you carry out continuous revision. Don't wait at the last minute in order to revise. No. Continue revising. When, for example, when you are done with topic number 1, go to the revision books, look at the questions that have been tested in the past under this topic, because in the revision books, we have organized the questions topically. So it's very easy for you to locate questions based on the topic that have been that we are covering in the subject leadership and management. So candidates, thank you for choosing to study with the Manifesto Publishers. We endeavor, we plan, we are ready to help you gain the required skills, the required attitudes and knowledge that will enable you meet the objectives that I read here. Remember, by the end of this training, number 1, the syllabus states that you should be able to demonstrate an understanding of leadership techniques and management principles. Number 2, you should be able to apply knowledge of leadership and management theories in organizations. Number 3, you are expected to effectively undertake management functions. Number 4, a student or candidate who passes this paper should be able to make rational management decisions in an organizational context. Then lastly, you are expected to embrace and manage strategic change. It's not just about knowing the principles or memorizing a few concepts. No, at the end of the training, it is envisaged that you should embrace and manage strategic change among the other objectives that I have read. So that is our intention. That is our purpose, to equip you with the knowledge, with skills and attitudes that will enable you to apply and demonstrate leadership and management skills that will enable you to grow an enterprise under various environments or circumstances, including environments and circumstances that are uncertain. So you can see, candidates, the training is not limited to you passing the exam. The skills that you gain here should enable you to demonstrate, to practice, to manage, to apply, to embrace, to make rational management decisions in an organizational context. So thank you one more time, and hope to see you as we continue studying leadership and management. Bye-bye.
I greet you all and welcome you back to the Manifested e-learning platform. The subject is meetings. We are studying the governance standards and guidelines. Today we are moving to guideline standard number 006 on registers and records. Governance standard GS 006, registers and records. This is a standard that governs the corporate memory. We are talking about records, candidates. Previously, we studied minutes and resolutions, which record decisions. Minutes, resolutions. Minutes is a record of what transpired in the meeting. Right? Resolutions, we say these are the decisions that are made during the meeting. Today we are moving to records or registers. Registers record the status and identity of company stakeholders. They record the assets of the company and legal obligations. And under this standard, the company has a statutory duty to maintain specific books that are accurate, that are up to date, and available for inspection. That is the requirement of this standard. Understand? Yes. Registers and records. The standard ensures that the company remains transparent to the regulators, to the shareholders, and also to the creditors. It is a legal requirement. The company has no option but to maintain records and registers. So first of all, let's analyze the statutory registers, which is a mandatory requirement. Statutory, number one, statutory registers. Every company is legally required to maintain certain statutory books or registers. This is mandatory. Mandatory. The first book is known as Register of Members. Register of Members. Members are just the shareholders. These are shareholders. Register of Members. The definitive record of who owns the company is what we are referring to as the Register of Members. That's the first mandatory book that is required to be maintained by a company. Who owns that company? We can tell the owner of a company by reading the Register of Members. Who owns the company? A person is generally not a legal shareholder until their name is entered in this register. Until your name is entered in a register of members of a company, you cannot claim to be a member of a company. It is a statutory register. You want to tell the owners of a company, then you make reference to the register of members. There you will find the shareholders of the company, those who own the company. That's the first book. The second register is register of directors. Register of directors and secretaries. These are the officers of the company. The officers of the company. Register of directors and secretaries. This register details the leadership. It provides the details of the leadership, including their names, their addresses, their dates of appointment, and also resignation. If they resigned, if you are a director of a company and you resigned, that record, you can find it in the register of directors. You are appointed, then you must appear in the register of the directors and secretaries. Then the third book is register of directors' interests. Register of directors' interests. The company is also under legal obligation to maintain a register of directors' interests. This records any shares that is held by directors or contracts where they have a personal stake. If you are a director and you own shares in the company, that has to be part of the register of directors' interests. If you are a director and there is a contract that was issued to you, or a contract where you have interest, then that has to be part of the register of directors. That's the third statutory register. Or register of charges. This is yet another important register, the register of charges, and this could also be mortgages. Register of charges or mortgages. This is a list of companies' assets that are used as security or collateral for loans, and this register is crucial for the creditors. If the company has taken loans and it has charged the company's assets, then that information must be recorded in a register of charges. Those assets that are used as collateral must appear in the register of charges and mortgages. Understand? Yes. 3. Register of beneficial owners. The register of beneficial owners is the 5th register, which identifies the persons with significant control who may own shares through holding companies or through trusts. Those who have significant control. They could be owning the shares of a company through other companies, and that has to be documented in the register of beneficial owners. Register of beneficial owners. Understand? Yes. So these are mandatory registers. Mandatory statutory registers. Then let's discuss location and inspection rights. Location and inspection. Location and inspection rights. We are talking about the inspection of these records. First of all, we have identified the records. So we want to discuss to analyze the location and inspection. Now, GS006 defines where these records live or are located and who can see them. And the first location is the registered office. 1. Registered office. The registered office. Records must typically be kept at the company's registered office or a designated single alternative inspection location. If it is not the registered office, then it has to be the designated single alternative inspection location. So that is where the records are required to be kept. Then number 2, we have public inspection. Public inspection. Public inspection. Shareholders usually have a right to inspect registers for free, but the general public may often do so for a small fee or upon stating the proper purpose for wanting to inspect the documents. 3. Digital versus physical. Digital versus physical. Most modern standards allow for digital registers, provided they are secure, they are backed up, and can be printed upon request. So if the records are digitally located, then the records should be printable. The records should be secure, and they are supposed to be backed up. There ought to be a backup for the digital records. You understand? Yes. So this is ABC. ABC. Then 3, retention. Retention. We have to discuss retention as per GS006. Retention. How long must records be kept? Now, while laws vary by region, the standard generally allows for certain benchmarks. Okay, we are going to have the benchmarks here. Let's have a column for record type. And have a column for record type, then another column for retention period. Retention. The laws of the country may give direction or provisions on a retention period. So the laws vary by jurisdiction, but the standard 006 registers and records, they provide a benchmark. So let's begin with the statutory registers. The first record type is statutory registers. Statutory. The statutory registers, they Retention period for statutory registers is for life. These records are stored permanently. The record cannot be deleted. It is retained for the life, permanently for the life of the company. Before the company dies, these records must be maintained. That is statutory registers. These ones here. Register of members, register of directors, register of the directors' interests, register of charges, register of beneficial owners. Permanently retained. Then we have minutes and resolutions. Minutes and resolutions are often permanently stored, but at least 10 plus years. This is 10 plus years, 10 years, 11 years, or permanently. That means they are not stored for less than 10 years. 10 years permanency. Then number 3, we can have accounting records. Accounting records. This could be the income statements, the financial statements. Accounting records are required to be kept. The standard recommends 6 to 7 years. They have to be kept for a period of at least 6 to 7 years. Employee records. Employee records be kept for a period of 4 to 7 years. 4 to 7 years post termination. After termination of a contract of employment, then the record of the employee has to be maintained for a period of not less than 4 years and not more than 7 years. 4 to 7 years. It could be 4 years, 5 years, 6 years, or 7 years at least. So that is information on retention periods. Retention periods. Then candidates, let us discuss the role of the corporate secretary, because the secretary plays a key role when it comes to registers and records. In fact, the corporate secretary is the custodian. The custodian. This candidate is just retention periods. This is retention. Let me title this as retention of records. The record type is here. So what is the secretary's role? This is number 2, number 3, then number 4, role of the corporate secretary. This is the role of the corporate secretary in relation to the registers and records. Now, under GS 006, the secretary is the custodian of the records. The corporate secretary, the company secretary, is the custodian of corporate records, of company records. And their duties include updating. The duties include 1, the first duty is to update the records, updating the records. The secretary should ensure changes like the share transfers are recorded within the legal window. And the legal window is most of the time 14 days. All right? Updating. Before we talk about filing, there is validation. Validation. before the documents are filed, the company secretary has a role to carry out validation, to verify that information provided by directors and shareholders is accurate before entry or before filing. Before entering information in these registers, it is the role of the corporate secretary to ensure that the information is accurate. Then number 3, filing. Filing. It is also the responsibility, the legal responsibility of the corporate secretary to notify the national registry, like the register of companies, whenever a register is updated. Whenever a register is updated, the corporate secretary is to ensure that that updating, that change is communicated to the register of companies. Okay, that's the end of today's lesson on governance standards, governance standard number 006, registers and records. In this lesson, we have identified the statutory registers which are mandatory. 1 is register of members, 2 register of directors and secretaries, 3 register of directors' interests, 4 register of charges and mortgages, 5 register of beneficial owners. We've also discussed the location and inspection rights of these records. These records we've seen must be kept at the registered office of the company. There is also public inspection. The shareholders have a right to inspect these records without any charge. The members of the public may be required to pay a small fee or to state the reason why they need to inspect the records. We've also made mention of digitalization and physical of these records. We say that if the records are digitally kept, then they should be secured, they should be backed up. These records should also, the company should ensure that the records are safe, right? Then there is retention. And of course, in this lesson, we have studied the retention periods. Retention, you have retention periods. For statutory registers, they are permanently retained as long as the company is in existence. Then we have minutes and resolutions which are retained for a period of 10 plus years. Accounting records are kept according to the standard between 6 to 7 years. Employee records 4 to 7 years post termination. That is, after termination of employment, these records must be kept for a period of 4 to 7 years. Then we've, in closing this lesson, discussed the role of the company secretary. The first role is updating, validation, and then filing. So it's important, candidates, that a company maintains these registers, because failure to maintain these registers is often a criminal offense for both the company and its officers. And in many jurisdictions, the register of members is the only evidence of the title to the shares. So if it is lost or inaccurate, then ownership disputes can paralyze the company. So thank you for attending this lesson on GS006, registers and records. We continue to learn more on governance standards and guidelines in our next lesson. Important for you to also remember that over and above the video lectures, we have prepared for you study texts which contain notes for the entire syllabus. We also have revision books where we have answered past KASNEB question papers. The answers are topically arranged in the books. All these materials are available in hard copies. You can visit our shop or you can place your orders using our official lines. Thank you. God bless you. Bye-bye.
Welcome to Manifested Publishers. My name is Mr. Bernard Mariga. I'll be teaching you advanced management accounting, and today I want us to talk about expected value of perfect information, which is one of the subtopics in planning and decision making. Now, the expected value of perfect information is the value that you are going to get when you obtain perfect information. And the expected value of perfect information can be determined by taking your expected monetary value with perfect information, minus your expected monetary value without perfect information. So basically, expected value of perfect information, this we can simply summarize it as the value you obtain of flawless information. Information. I will start by showing you how you determine the value of perfect information using the payoff table. Using your payoff table. You can also determine the value of perfect information using your decision tree. But let me start by determining the value of perfect information using which method? Using payoff table. So using the payoff table, and we will go to a question on December 2024. 4C. Let's go to question 4C. Should be question 4C. Though we will need to use information on 4B. 4C is saying Lambda Investment Enterprise Limited is contemplating acquiring perfect information from an investment research firm about the viability of the investment opportunities. The investment research firm is willing to provide perfect information about the investment project at a cost of 30 million. Required. Using suitable computations, advise Lambda Investment on whether or not to acquire the perfect information from the investment research firm. All right. Now, so what we need to do is we determine our value of perfect information by getting the expected monetary value with perfect information minus the expected monetary value without perfect information. So, as to do that, we need to prepare a payoff table. So, let's have the states of nature, and in this case, your states of nature were what and what? Remember, your states of nature, we've said, they are those events that cannot be controlled by management, and they should have prior probabilities if you're dealing with risk. And this was your economic conditions. This is your economic conditions, which was optimistic with a probability of 0.3, most likely with a probability of 0.4, and pessimistic with a probability of 0.3. Your decision alternative was here or will be here. You can either invest in corporate, shopping mall, and lastly, residential area. And then we now represent our payoffs. Let's represent our payoffs. 100,000, 70,000, 130,000. Shopping mall, 110,000, 90,000, 90,000. Residential, 90,000 is your payoff, 120,000 and 70,000. 170 what? 1,000. Now that we have drawn our what? Payoff table, let's determine our expected monetary value with perfect information. Your expected monetary value with perfect information will require that you select the highest payoff for each state of what? Nature. For optimistic, that is your highest payoff. For most likely, that is your highest payoff. For pessimistic, that is your highest payoff. Then these highest payoffs here, you multiply by your probabilities. Why? If you knew under optimistic that the shopping mall is the best decision you could make, there is the most likely chance or the best decision is to choose what? Shopping mall. If under most likely you knew that the residential results in the most payoffs or the highest payoff, you're going to select what? Residential. In pessimistic, if you had enough information and knew that the corporate is the one with the highest what? Payoff, you would have selected what? Corporate. And that is why we say this expected monetary value with perfect information, which is your maximum payoffs of each what? State of nature. Then you multiply by your who? Probabilities. Remember, expected, you must multiply with your probabilities. And how will that be? You're going to say it is 110,000 with a probability of 0.3 plus 120,000 with a probability of who? 0.4 plus 130,000 with a probability of 0.3 with a probability of 0.3. 110 by 0.3 plus 120 by 0.4 plus 130 by 0.3. So expect how much? That your expected monetary value with perfect information will be how much? Will be 120,000. The next thing I want us to do is to determine your expected monetary value without perfect information. Expected monetary value without perfect information. And the expected monetary value without perfect information is simply your EMV, your maximum expected monetary value. And how did we get your expected monetary value? You simply take your payoffs by the probability. For example, corporate. We have done this previously. Corporate, you're going to take 100,000 by who? By 0.3 plus 70,000 by who? 0.4 plus 130,000 by 0.3. Then shopping mall, 110,000 by 0.3 plus 90,000 by 0.4 plus 90,000 by 0.3. Residential area, 90,000 by 0.3 plus 120,000 by 0.4 plus 70,000 by 0.3 by 0.3. 100 times 0.3 plus 70 times 0.4 plus 130 times 0.3. This should be 97,000. Shopping mall, 110 times 0.3 plus 90 times 0.4 plus 90 times 0.3. That should be 96,000. 90 times 0.3 plus 120 times 0.4 plus 70 times 0.3. 96. But remember, using the expected monetary value approach, you normally select the one with the highest. So this is what? 97. This is your EMV. 97, 96, and 96. So you select the highest. That is the highest. Okay? So therefore, the expected monetary value of perfect information will be your expected monetary value with perfect information of how much? 120,000 minus your expected monetary value without perfect information, which is the highest EMV, it is 97,000. So 120 minus 97, which is how much? 23,000. 23,000. 23 what? 1,000. That is the value that you expect to obtain when you acquire perfect information. When we say acquire perfect information, is where you can hire a company. Then when you hire that company, the value they will give you is worth how much? 23,000. But part C of that question, they are asking advice on whether or not to acquire perfect information. So here what you will do, you will simply now compare the value of perfect information and the cost of acquiring that perfect information. The cost of acquiring perfect information is how much? 30 million, so 30,000. So when you acquire perfect information, it will be worth how much? 23. But how much do you expect to incur for it? 30. So therefore, what will you advise them? You will advise them, do not acquire perfect information. Why? Because it is more expensive to acquire than the cost you're going, than the value you're going to obtain, So you're going to advise them not to acquire perfect information because it is far much expensive. The cost outweighs the value you obtain. That is how you deal with expected value of perfect information, but using what? Payoff table. Using payoff what? Table. So remember, it is simply the difference between expected monetary value with perfect information minus expected monetary value without perfect information. And you've said the expected monetary value without perfect information, simply you must determine your EMV, expected monetary value, then the maximum. I hope that is clear. Welcome to Manifested Publishers. My names are Mr. Mariga. I'll be teaching you advanced management accounting, which is in the advanced level. Today we will talk about a topic known as cost estimation and interpretation. Cost estimation and interpretation, which is a topic closely related to cost estimation and forecasting that was covered in the intermediate level. So what we're doing here today and in this lesson and for this particular topic is simply developing that what we learned in intermediate level under cost estimation and what? Forecasting. Now, cost estimation here simply is the study variables. Dependent variables here are your costs and independent variables. Which are what? your activity level. Your activity level or your output. Okay, then once you have identified how they relate, how the dependent and independent variables relate, or how the cost and your activity relate, the next thing is forecasting, where forecasting or cost forecasting, simply it is an attempt to predict future costs, using the cost relationship obtained, using the cost relationship obtained, using the cost relationship obtained. So simply it is using this cost estimator equation here or relationship, then you use it to predict a future cost. You use it to predict a future what? Cost. Then interpretation here simply is how you interpret or how you further analyze whether the cost estimator relationship is good or whether it is significant or not significant. We have two main methods of cost estimation. We have two methods. The first method is linear relationships or linear methods. Under linear methods here, we normally assume that cost when plotted or the equation or the cost relationship is linear in nature. So here the assumption is that the cost relationship is linear in nature. Here they are saying the cost relationship linear in what? Nature. When we say it is linear in nature, we basically mean that the equation can be expressed in the form y is equals a plus who? bx. It can be expressed in the form y is equals a plus bx, or your cost is either fixed or variable cost. Your cost is either fixed, which is f, plus a variable cost vq, where y C is your dependent variable. Your what? Your total costs. That is your dependent variable or your total cost. A or F is your fixed cost. Is your slope, or not slope, but the y-intercept, which is y when x is who? 0, which could also be mean that this is your fixed cost. That is your fixed costs. Then B and V is your gradient or your slope, which is your change in y over change in x, meaning it is your variable cost per who? Per unit. B, which is V, this is your slope or what? Gradient. Slope or gradient, which also means that it is your variable cost per unit, which is your variable costs per unit. Remember, your variable cost changes with output. It increases with increase in output and decreases with decrease in output. X or Q, X here is your activity level or your independent variable. So this is your independent variable, which is also your activity level. which could also be your output. Then the product of your variable cost per unit and your activity level will give you your total variable what? Cost. Your total variable costs. Alright. So with linear methods, the relationship is in the form y is equals a plus what? bx, or cost is equals to variable plus to fixed plus variable costs. We have examples of methods of linear. Examples of linear methods. Examples of linear methods of cost estimation. Examples of linear methods of cost estimation. The first method is high-low method. Then we have ordinary least squares method. Ordinary least squares method. The third method is accounts analysis. Accounts analysis method. We also have industrial engineering method. Then lastly is method of scatter graph. Scatter graph method. So let's start with the first method known as the high-low method. So the first method is the high-low method, cost estimation. Now this method known as high-low method requires that as a user of management accounting information, that you form cost estimator equations that are of the form y is equals a plus bq, or bx if you so wish to call that bx, that way, such that this equation here will be of costs. Remember, y is your cost, a is your fixed cost, b is your variable cost per unit, and x or q is your output. X or q is your output or your activity level. So using high-low method, we start by selecting your dependent and independent variables. Dependent and independent variables is y and x, or y and q. And how do we do that? We select the highest value of the independent variable x and the cost incurred. Then you select the lowest value of x and the cost incurred, such that now you will have 2 points. You will have 2 points that you can then use to form an equation. And I want us to look at a question of December 2024. December 2024, question 1b. And the company name is known as Mario Processing. They're saying, or they're stating, the management of Mario Processing Company Limited wishes to obtain a better cost estimate to evaluate the company's operations more effectively. The following information is provided to you for analysis. You have your year and the month, the equivalent production units in thousands, your overhead shillings in thousands. You have the month is from January all the way to the month of December. In the month of January, you're producing 1425, incurring 1285. February, producing 950, incurring 9875. March, 1130, a cost of 10450. April, 1690, a cost of 15280. May 1006, a cost of 99.15. June 834 is your units, your cost is 91.50. July 982 units, overhead of 10,133 shillings. August 1259 units, a cost of 11,981. September 1385 units, a cost of 12,045. October 1420 units, a cost of 13,180. November 1125 units, your overhead is 11,910. And December 980 units with an overhead cost of 10,431 required. Using the high-low method, formulate the overhead cost function in the form of y is equals a plus b x. Using the high-low method, formulate the overhead cost function in the form of y is equals a plus bx. Let me start by listing down all these costs. We'll have the month, you have your units, there, and you have your overheads. I want to list them down. Why? So that I can show you what is happening clearly. You have the month of January, Feb, March, April, May, June, July, August, September, October, November, and December. Your units is 1425 with a cost of 12,185. February 950 with a cost of 98.75. March 1130 with a cost of 10,450. April 1690 with a cost of 15,280. May 1006 99.15. June 834 cost of 91.50. 982 10,133. August 1259 11,981. Then September is 1385. Last that is 1205 as your cost. October is 1420, 13,180. November 1125. This 11,910, 980, and lastly 10,431. 10,431. We have listed down all the costs and the units that were produced. Now, after we have listed down that, or using this data now, we need now to form equations of the form y is equals a plus bx. But for us to do that, we need to ask ourselves, what is y and what is x? Y is your cost, or the dependent variable. We say it is dependent because it can only be incurred when you do what? When the independent variable is incurred. So the y, which is the dependent variable, it is dependent on the independent variable. And in this case, y will be your overhead cost. Y will be your overhead cost. So that will give you y. then that automatically means X is your who? Your output or your units produced. So this is X. There. Your units produced is X. Your units produced is X. Why are we saying that? Because the overhead costs were incurred as a result of the units being done what? Produced. Then what did you do? You select the what? The highest independent variable X and the its cost. You also select the lowest independent variable X and its cost. So from the month of January to the month of December, I can see the highest units produced. The highest units produced, I can see there the month of April, which is 1690 units. And when you produce 1690 units, you did incur an overhead cost of how much? You incurred an overhead cost of 15,280. 15,280. That is from the highest points. Then your lowest units is the month of when? June. You produced 834 units and ended up incurring a cost of how much? 91.50. A cost of 91.50. Once that is done, you have successfully selected the highest and the lowest units and the cost incurred as a result of those highest and lowest units being produced. The next thing we do is we then form two simultaneous equations of the form y is equals a plus what? bx. But how do we do that? We simply substitute the values of y and x. So we form equations. And the equations, remember, should be of the form y is equals a plus what? bx. You have your values of y and x. So you simply substitute now and say 15,280 is equals to a. You don't know the value of b, but you know x is 1690. The second one will be 9150 is equals to a plus 834 of b. 834 of what? B. Okay, that is that. Then what then do we need to do? We then solve for the value of a and b. To solve for the value of a and b, we know b we said is your gradient. So what does it mean? You simply take the change in y over change in what? X. B, chukua change in y over change in what? X. How is that possible? Your y is 15,280 minus 9150 divided by who? X. 1690 minus 834. So the value of b will be 7.16. 7.1612. Then once that is said and done, what do you then do? You then substitute the value of b in either the first or the second equation so that you determine the value of a, so that you can use it to determine the value of a. Say 15,280 is equals to a plus 1690, but the value of b we've just obtained it as 7.1612. So now A will be 15 to 80 minus, so the value of B should be, of A should be 3177.5467. So your equation that is straight line in nature should be y is equals to 3177.5467 plus 7.1612 of who? Of x. And that is how you form a cost estimator equation. Using which method? Using high-low method. Using the high-low method. All right. This method has some of the advantages, or some advantages, such that it is very easy to explain to an user. Does not take a lot of time. But one of the main disadvantages of the high-low method is that it only considers two observations, which is the highest and the lowest. All the other observations are ignored. Another disadvantage of this method, you cannot use it when you have more than one what? Dependent or independent variable x. You cannot use it more where you have more than one independent variable x. You can only use it when you have one x. Right. The other disadvantage of this method is that the validity and reliability of this equation cannot be done what? Determined. You cannot interpret and say that this method or this regression equation we formed is accurate or is not accurate. Or if it is accurate, to which level is it accurate, and so on and so forth. So those are some of the challenges of the high-low method. And these challenges of high-low method, can be done what? Can be mitigated using the ordinary least squares what? Method. So I want to talk about the second method, the ordinary least squares method.
Now allow me to move to the next part of the question, which is on CVP. Let's move to the next part of the question. Part C of the question reads, Tinga Limited manufactures and sells a single product named T140. The following information relates to the product. Selling price per unit is 180. Variable cost per unit is 80 shillings. Fixed cost per annum 5 million. Required Roman 1, break-even point in shillings and in units for max. Roman 2, the total number of units, the number of units to be produced to earn a profit of 1.2 million. That is the question. We need to calculate, first of all, the break-even point in units, then the break-even point in shillings. So this is part C. We are to calculate the break-even point in units. To calculate the break-even point in units, we know the formula is fixed cost over contribution margin. Just fixed cost over contribution margin. So what is the fixed cost in this question? 5 million. The fixed cost here is 5 million shillings. What is the contribution margin? We know the contribution is equal to selling price minus variable cost. Contribution margin is equal to selling price minus variable cost. The selling price here is 180. The variable cost from the question is 80. So that will give us the break-even point in units. This will be equal to 5 million divide 180 minus 80 is just 100. It's just 100. This is equal to 50,000 units. Now, this is the break-even point in units. That means that if the company is to produce 50,000 units, the company will not make any profit, because at break-even point, profit is equal to 0, which means that the total cost equal the total revenue. At break-even point, total revenue is equal to total cost, and we know profit is equal to total revenue minus total cost. So total profit is equal to revenue minus the cost, which will be equal to 0. If the company produces 50,000 units, there is no profit at this point. This is the break-even point. The first shilling of profit will be made after the 50,000th unit. That will be 50,001 units. So that's the break-even point in units. Then to calculate the break-even point in shillings, that will be equal to the fixed cost over contribution margin ratio. Contribution margin ratio. So we are going to have it at 5 million minus the contribution margin ratio. How do you calculate the contribution margin ratio? Contribution margin ratio is equal to the selling price minus variable cost. That gives us the contribution. Then we divide by the selling price. So this will be equal to 180 minus 80 over 180. So that will be the contribution margin ratio. So 180 minus 80 is equal to 100. 100 divided by 180. This is equal to, the contribution is 0.55555. So we divide the 5 million. This gives me 0.55555. So I'm going to divide the 5 million by that ratio. 5 million divide 0.55555. So roughly I'm getting 9 million. When I round off in shillings, this will be 9. That is the contribution margin. I mean the break-even point in shillings. The break-even point in shillings is equal to 9 million shillings. So that is how candidates to calculate the break-even point in shillings and in units. Then the second part of the question reads, look at the question. The number, this is Roman 1, C1, C2, we are to calculate the number of units to be produced to earn a profit of 1.2 million. Number of units to earn a profit of shillings 1.2 million. Now this will be determined, the formula to the number of units. You have to calculate the number of units to earn a profit of 1.2 million. This will be equal to the fixed cost. You remember the formula we gave in our class. This will be equal to the fixed cost plus the target profit. We get the fixed cost plus the target profit. Then we divide by the contribution. We divide by the contribution margin. We divide by the contribution margin. So we know the fixed cost is 5 million. We know the target profit is 1.2 million. This 1.2 million, 1.2 million. We know the contribution margin, because it's supposed to be units. The contribution margin, we had calculated it. Contribution margin is 100. This is the contribution margin, 180 minus 80, which is equal to 1. So this will be equal to 5 million plus 1.2, that's 6.2 million. That will be equal to 6.2 million. 6.2 million divided by 100. This is 62,000 units. 62,000. So if the company intends to earn a profit of 1.2 million, then the company must produce 62,000 units. And you can see 62,000 units is greater than the 5,000 units at break-even point. So profit is made at after 1,000 units. At 50,000 units, there is no profit. If the company is to make a profit of 1.2 million, then the company has to produce 62,000 units. That is the meaning. So it's possible to calculate the number of units at a given target profit. So that's it, candidates, for today's lesson. We've answered the question that was tested in August 2024, question 3. On our website, we have provided more questions. Our intention is to answer all questions that have been tested before. If you go to our website, you'll find all these questions have answered, and we subsequently revise our content to ensure that we capture all present sittings. If you have any questions, please feel free. You can get us directly. We have our numbers online. If you have questions, if you need special attention, please call us, and we are ready to help you pass your exams and to gather knowledge that will be useful as you build your career. Bye-bye. Greetings, candidates, and welcome back to the lesson. The subject is meetings, compliance, and administration. We are continuing with the topic on governance, standards, and guidelines. So far, we've covered guideline standard number 001, 002, 003, 004, 005, 006. Today, we move to governance standard number 7, GS 007. This is filing annual returns. Filing annual returns is our today's focus. That is governance standard number 007. And this is the standard that ensures that public record of a company is kept current. It is done what? It is kept current. Because while many mistakes an annual return for say tax returns, the GS 007 focuses on statutory compliance. Many mistake an annual return for tax returns. But GS 007 focuses on statutory compliance. That means confirming that the company's structural details, like directors, shareholders, and their addresses with the government register, are accurate. So GS 007 is a standard that mandates that an organization provides a periodic health check to the registrar of companies, and that is to ensure transparency for the public, for the creditors, and for the investors. You understand? Yes. So do not mistake annual returns for tax returns. Here we are not discussing tax returns. We are discussing filing annual returns. All right? The standard focuses on compliance, statutory compliance, because the law mandates companies to make certain returns. So what is an annual return? If an annual return is not a tax return, then what is an annual return in the context of governance standards? Now, an annual return, candidates, is a statutory document that summarizes the company's legal structure as of a specific date. Let me define it. An annual return is a statutory document statutory document. First of all, it is a statutory document. An annual return is a statutory document that does what? That summarizes the company's legal structure. That summarizes the company's legal structure as at a certain date. All right? That summarizes the company's legal structure as of a specific date. As of a specific date. As of a specific date. That is the meaning of a statutory annual return in a snapshot. In a snapshot. That is the meaning. It is a statutory document that summarizes the company's legal structure as of a specific date. It is not a financial report, but a confirmation of the registered office. It's a confirmation of the company's registered office. It's a confirmation of the company's registered office. This is the physical and postal address of the company. It is also a confirmation of the company's officers. It is a confirmation of the company's officers. This is the current list of directors and the corporate secretary. It is a confirmation of the company's share capital. It is a confirmation of the company's share capital. That is the total number of shares issued and their value. It is also a confirmation of the company's shareholders. It is a confirmation of the company's shareholders. These are the owners of the company, names of members, and any share transfers that occurred during that year. It shows the list of shareholders and any transfers that were made during that specific year. Understand? Yes. It also confirms the company's indebtedness. It confirms the company's indebtedness. It details any mortgages or charges secured against the company's assets. Mortgages or charges secured against the company's assets. Indebtedness. You understand? So that is an annual return. Because you recall in our previous sessions, we covered the documents, the statutory documents, the statutory document, the statutory paper, the statutory document, registered office, company's offices, company's officers, the share capital, the shareholders. So an annual return, it is not a financial report. Neither is it a tax return, but it is a statutory document that confirms or summarizes the legal structure of a company as at a specific date. It confirms the company's registered office, the company's officers, the company's share capital, the shareholders, and indebtedness. Now let's discuss the deadlines and timing. Deadlines and timing. This is number one. Number two, deadlines and timing of filing annual returns. Okay, so in Analyzing the deadline and timing, we are going to have the milestone and the requirement. Let's have the milestone and another column for requirement. Milestone and requirement. We begin with the return date. Return date. The return date. This is usually the anniversary of the company's incorporation. These documents or confirmation must be done during the anniversary of the company's incorporation. The requirement is usually the anniversary of the company's incorporation. The company's incorporation is the birthday of a company. It is the day the company is born. So after the first anniversary, after the first year of incorporation of a company, then the company has to file annual return. Then there is the filing window. Filing window. There is a window within which the filing has to be made. And most jurisdictions require the return to be lodged within 20 to 42 days of the return date. 28 to 42 days. 28 to 42 days of the return date. That is 42 days or 28 days after the return date. The return date is exactly 1 year after the incorporation of the company. Understand? So filing has to be done by 42 days. Okay? Within 42 days, not more than 42 days. And it could be after 28 days, between 28 and 42 days after the anniversary. So it could be first anniversary, second anniversary, third anniversary, and so on. So that if a company was incorporated on 1st January 2024, the first anniversary would be 1st January 2025. So the filing date, the filing window, there is a window. It's supposed to be between 28th of January, then not more than 42 days after 28th day of January 2025. That is the filing window for a company that is incorporated on 1st January 2024. That is the filing window. Then another milestone is the AGM link. The AGM link. In many jurisdictions, the return is made up to a date shortly after the annual general meeting. That is General Standard number 001, annual general meeting. The return is made up to a date shortly after the annual general meeting. The date shortly after the annual general meeting, because general meetings are also held annually. That's why they are called AGM. This A stands for annual. So shortly after the AGM, these returns are supposed to be filed. Understand? Yes. So that is the deadline and timing of filing annual return. The GS 007 also has what we call a compliance check. To fulfill this standard, there are steps that must be undertaken. So what is the compliance check? So this is number 3. Number 3, compliance check. There are steps that must be followed when filing the annual returns. To fulfill the GS007, there are steps that must be undertaken. The first step is verification. Number 1, verification. 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 This is to ensure that information in the return matches the internal statutory records. Because what is filed is just information in the statutory records. If the company is to confirm the registered office, then the name of the registered office in the return should be the name in the register or in the name in the statutory records. So what is filed here is what is